Are you bullish stocks from here, or how do you see things?
Yeah, we are. You know, to build on kind of what you just talked about before I came on, listen, we all know earnings are strong, right? But the two things I want to point out here, profit margins also have been significantly increasing, kind of against what a lot of people expected. Also, CapEx expenditures are hitting all-time records. When you look at earnings and those other two things, Scott, it's hard for us not to be bullish. We've been overweight equity since December of 2022. You know, and a lot of people last year didn't like that call, but it obviously worked out. You look right now where we are. We had that 5.5% correction last month. We think that was enough to bring a lot of fear. We had that VIX spike above 20. We saw some, a lot of outflows coming in. We just saw a lot of fear, even though it was only 5%, because a lot of other stocks were down more, the big high flyers. We get it. And now here we are. May's off to a good start. And in an election year, this is seasonality, so don't just blindly invest in seasonality, but you tend to get a lot of strength in the summer of an election year. We don't think this year's playing out like that again. We think we could have a good summer rally here in an election year.
I'm glad you referenced the 5% pullback that we had in April. I mean, some would look at that and say it's just not enough, at least traditionally, to, shake out some things that needed to be shaken out before you can, refresh. Now, the market may be proving that incorrect because it's been a pretty strong snapback, as I said, at the top of the show. And you think it's believable based on earnings good enough, economy strong enough, and rate cuts eventually coming?
Yeah, you add it all up, we do. And again, you look at just how many stocks in the S&P were above their 20-day moving average back at the middle of April lows, and it was less than 10%. That's kind of washout material. We had the VIX, not to get too geeky here, in backwardation. Last time we saw something like that was like March of last year. I mean, you think about it. I mean, there was a lot of fear, even though it was only 5.5% correction, a mild correction, I should say, from that point of view. One other thing, and I think guests have pointed this out before, but I'll mention it again. May's higher than 9 of the last 10 years. Sell in May, go away. These worst 6 months have been higher 8 of the last 10 years. So again, history can repeat itself. It often rhymes. Mark Twain liked to use that. There are just many things. I think we had the washout. The economy's strong. The Fed is dovish. We can get into that here if you want. But overall, we're optimistic. We've been overweight. We still are.
I mean, they're dovish to a point. Let's put it this way. I'm not going to exactly suggest they're screaming dovish, but they're certainly at least the chair himself. And at the end of the day, that's really all that matters. The chair himself last week was not nearly as hawkish as some had feared. I don't know that I would go as far as to say they're all that dovish. I mean, they're certainly not cutting rates like we thought they once would. And, many suggest, whether it's Ken Griffin or otherwise, that, okay, we may get one, maybe not September or December, but we're not getting nearly what we thought.
No, you're right. Good pushback there, because again, it wasn't as hawkish, is a good way to put it. But we look at inflation was up over 9%, then down to 3% on the CPI. We know we've hit this little blip, if you will, and we're optimistic though, Scott. Inflation is going to continue to improve. I know wages are such a big part of that. The ECI last week scared everybody. Then we saw the positive wage growth. ADP also saw some decreasing year-over-year wage growth across the board. And then the supply chains are still improving overall. So the bottom line is this. A couple months ago, everyone said 6 to 7 cuts. That's what the market said. And then just 2 weeks ago, we're saying, listen, maybe no cuts, maybe even a hike. We pushed back against that. For the first time, I've been at Carson Group for 2 years. For the first time in 2 years, we added some treasuries, not a lot, just a little bit, about 3 weeks ago in some of the models we run for our partners, our advisors. And again, it's not like we're big bond bulls. We just thought that pendulum swung way too far, and we're so optimistic with the strong productivity. I know last week's productivity number was a little weak, still up 2.9% year over year. When you have stronger productivity like we think we will continue to see, the bottom line, I have higher wages. There's a little cover for the Fed to cut, and the economy tends to do a lot better when you have strong productivity. So we're optimistic there can be 2 cuts this year. Okay. Put a bow on it.
All right. So, I mean, if we do get the summer rally that you expect, what takes us there? What leads us during it?
Yeah, we've been overweight cyclicals. Last month, we added more to industrials and to financials, so those areas. But I know a lot of people come on, small caps, it's a dirty word sometimes. Small caps and mid caps, so if we start to see some more pullback in yields like we have, look what's happened, we think, that is one of those areas that's so underloved and so underappreciated that we could see a broadening out. And that's what's needed. We need inflation to come back to have that broadening out of this bull market. And we are slightly overweight, at least mid caps and a little bit of small caps in the models we run. So we think it's possible before this year is over that you're going to see some growth, some good outperformance there.